Thank you for joining iMeet. When you hear the tone, you will be the 23rd person to join the meeting. Being recorded.
Hey, good afternoon, everybody. This is David Blake with Tuesday Tech Talk. And today we're going to quickly review the last couple of days in the market, try to figure out what's going to go on next. And if this is your first time here, we generally talk about 20 or 25 minutes, and then we turn it over to you guys to ask some questions. If you want to ask about individual stocks or sectors or price targets, anything like that, we'll try to go over with that. I want to apologize for not getting an email out for today's Tech Talk. I was in Ohio visiting my 94-year-old dad, who helped me cut down a couple of tree limbs, drag them out to the street, and got home late last night. But what I want to do today is we're not going to go over a whole bunch of different stocks. I think we've done pretty well over the last three or four Tech Talks as far as getting you in the right groups and getting you out of the right groups or the wrong groups. And if you've been following the market letter, our targets for the Dow Jones was 21.5, 24.60 for the S&P 500, and 63.40 for the NASDAQ, which pretty much have all been hit or within a couple points. If you read Friday's letter, the CTI is projected to go to a sell this Friday. However, that will depend on the momentum index and sentiment index, whether we change that to a sell or maybe we go to neutral, or whether we extend another week or so on the bullish call. Those that have traded the triple leverage index ETFs last year, we were up about 70%. This year we're going to, as of this last call, we're going to be flat for the year. That's because we were bearish to start the year and really didn't go on a bullish call until sometime in March. So we'll get into that a little bit later and talk about what coming out of the bullish ETFs here over the next week or two. But first, let's look at the broader market real quick and see what happened here. Okay, here we are with the Dow Jones through part of today. We're at 21,511. We made a series of new highs. The Dow was up for a fourth straight week. In fact, we made a new high for the last 5 days. The momentum index, despite the Dow going up to a new high last week, actually came down a point. It's at a neutral +2. The sentiment index rose to a neutral +1. If you're wondering how the momentum index can stay neutral and go down when several of the indexes are making new highs, what we do is I measure how the other indexes and some breadth indicators are performing versus the Dow Jones. And the Dow Jones is up 10%, but this goes up 8%. That's probably take a number off of the momentum index. That'll be a little bit of negative divergence. So that's how we can get it. And what I want to keep an eye on this week is, with this big move in the Dow Jones, are the other indexes going to be able to continue to push to new highs, or are they going to start to roll over? If they do, that would be the negative divergence that I'd be looking for to take off this bullish call at that stage. So don't know what it's going to be, but make sure you get into Friday's weekly market letter so you know what's going on with that. Let's see. Okay, last week the Dow was up, about 0.6%, I believe. The S&P 500 was up a point, but the NASDAQ and Russell 2000 were both lower. Breadth was also bullish for the NYSE, but it was mixed on the NASDAQ as the AD line lost a little bit. Economic data was also soft last week. We had several reports, including factory orders and housing numbers that missed the mark. And we also saw the CPI fall 0.8%, which shows inflation is not a factor. But you have to keep with this inflation number that a lot of that shortfall in inflation is due to falling crude oil prices, and that's going to weigh on inflation numbers for a while until this thing's the bottom. We had a strange mix in the sectors last week. Investors got a little bit defensive. Utilities and REITs were higher, but also we had industrials and financials, and a little bit of healthcare was also higher. Granted, General Electric was behind the move, a big part of the move in the industrial sector, but also we had Boeing, United Technology, a few other ones that were outperforming, and part of that is because the U.S. dollar has come down, which helps the multinational, especially industrials. The reason for that is if the other economies are getting strong, and that's going to help sales, obviously, but also you don't have the currency exchange where you lose some of your profits when you bring back your sales, but your money back to the States that you were having over the last year or two. If we get a higher euro as that economy improves, the multinationals or the industrials will be a place where you're going to want to probably add some more of the positions. If the international economies are growing, that's good for business. Also, healthcare, which we've been talking about, continues to lead this market. We'll look at some of these ETFs in a little bit, especially the medical devices and medical supplies. Those are two of the top 5 performing industries right now in our industry group analysis. I don't know, it was either last week or 2 weeks ago, we listed a whole ton of stocks that we thought you could buy and make some money, and they've worked out really well. Last week was more on the financial side, which we had a breakout. We'll look at that too. So anyway, here we are at the Dow Jones. We broke out, had a gap up there yesterday, 144-point move up. We're kind of treading water here today, down just a tad. We had the AD line, which is considered a leading indicator of market direction, just continues to keep going higher. That's showing broad participation in the moves higher. We also had 23% of the stocks that market edge follows are within 1% of a new high. That's also bullish. It also confirms the move higher. I'm not going to look at the S&P 500 just because it basically looks the same as the Dow. So it still looks higher. There's no negative divergence in that at all. Here's the NASDAQ, and you can see over here the big tech wreck from last week or the week before. I'm not sure when it happened. We hoped that what we would get would be some backing and filling. We didn't want to see this thing go from here and go straight up like you did over here or this thing. So we were getting what we wanted. We had a little gap up, came down over here, gap back up, kind of going sideways here. As we mentioned last week, you want to have if there were stocks that you missed out on, the Nvidias or Microsoft or something that AMD or whatever that you wanted to pick up and you didn't, and you missed it over this section, you may want to buy a half a position. If it comes back down here to test this trend line, maybe add to another to the rest of your half position at that point. So this is what we want to see. A lot of times in these talks when we talk about the 14-day RSI, and I tell you, as long as the 14-day RSI stays above 40, you're still in the bullish trend. And as you can see here on these pullbacks, you've stayed pretty much almost at about 48, 49, 50. So you haven't even come down to test where if this was made a higher or a lower high here, and this comes over, starts to roll over, and then you see this come down here where we get down to about 30, to the 25, 30 area, then you know that we're going to be in for probably 30, 45-day period where we're going to go maybe a softer market. As you can see, this whole upswing here, it's always stayed above the 40 range. We got down here, but it bounced back, turned around real quickly. And again, on this 30-day stochastic that I like to see this thing always be above 50. This came right down on this sell-off to the 50 level and bounced off of that. That's good. You can still see the accumulation in the NASDAQ. Here was the tech wreck coming down in here, and now we're bouncing back. We want to see that if we're going to break out, we're kind of getting up to a double top on this. But so far, so good on the advanced decline line for the NASDAQ. I think that hopefully we can still work a little bit higher. All right, the next two charts that we're going to look at, we've mentioned several times that the Dow Jones Transportation Index and the Russell 2000 are kind of the key as to whether or not we can get a fresh leg up. This is the transports. We're having a pretty good sell-off today. In fact, it's down. We're down 130 points. We're down almost 1.5%. This isn't updated yet, but We're down here to this level here where we kind of broke out. With this thing here, we really want to kind of make sure that this could lead the market lower. If we can get a breakout here to a new high, I would doubt that we would flop over to a bearish call on the market, either this or the Russell 2000. But a 1.5% move lower. I looked earlier. Every single component in the transportation index was in the red, and that's when you also look on the other side, when you have crude oil prices down almost 3% today. Also, the trucking stocks in that transportation index were some of the worst performers today, but in general, all of them were. So this is, we're getting some negative divergence going on in here. You actually had some nice, a little bit of a breakout with this part here on the advanced decline, but keep an eye on this thing. If we break down here and test this 100-day moving average or 50-day moving average, and you start to see this thing start to go a little bit below that, that would signal to you ahead of time. If that would happen on, say, Thursday or Friday, then you could probably bet that we're probably going to go to a sell in the market at that stage. Here's the Russell 2000. It's also underperforming today, but it's only down 0.6%. We're still kind of, going along here. Now the question with the Russell 2000, we made a new high, over here, but was that just a throwover from this range? And right now we're back in this range. It's been going on since back to December, actually November there. This thing comes back down here and tests the 100-day to 50-day. That would probably also give us a drop in our momentum index, which could lead to to sell on that. All right, this is going to be a little bit of shorter of a meeting today, because we've had some pretty good weeks on this thing, and again, the fact that the next couple of days are going to be kind of important for our cycles and all, to see if we're going to stay bullish or not. We're going to kind of be neutral the next couple of days. But here's the first thing that's leading this market higher. This is XLV. This is the healthcare. This is still where you want to be. We're getting a little overextended. Bullish indicators down here. I still like that. As I said earlier, the medical devices and medical supply stocks are still the leader in the whole market. If you go into the advanced tools on Market Edge, look under industry group, or if you're on the new beta site, there's an industry group tab of its own. Pull that up. Look at the strongest stocks in that industry. Those are some plays that you might get in on here. Now we're overbought over here. You can see this. The 14-day RSI is up here around 79.80. So we might get a little bit of a pullback if the whole market pulls back a little bit. That might be some time to grab some of those. But it's this is a strong sector. It looks really good. Now this is a little bit strange. This is one of the second best performing sectors right now, and that's utilities. And in a rising rate environment, that's not usually the case. Now there's a couple scenarios that could be causing this. Although we're seeing a little bit of negative divergence in this, I'm not sure I would be a big buyer of utility stocks despite this little breakout over here, and that's because if rates continue to go a little bit higher, so far the 10-year has really fought off three rate hikes. We're at 2.15 today. That's back where we were back here in November before we had the December rate hike and everything else. So the market doesn't believe that rates are going higher, and it's like I say, it's been fighting it all along. That's why as long as the 10-year stays down here at 2.15 or below 2.25 at least, utilities will be fine. I'm not suggesting you sell them at this point, but if the 10-year gets up above 2.60, which is another half a point from here, then that's the point where you want to start getting out of your REITs and your utilities. So if you're in here, I would go along for the ride. I wouldn't be aggressively buying these at this stage, but I think it can work its way higher as long as the 10-year stays down. Now over here we have the industrial select spider, and we see this thing breaking out to new highs, leading the market. You can see some nice positive moving in the indicators. A little bit overbought in this area. We're kind of backing off a little bit today. This big candle here is the last week when General Electric, Jeffrey, I'm off or whatever, resigned, and you got a big bounce in that. And industrials, they look good in here. As far as we go, if you look at United Technology, Boeing, all these, General Electric looks strong, and part of that is because of the weaker dollar. Now, this next chart will kind of confirm what we're seeing here, but I want you to also keep it in mind. Like when we looked at this with the oil, this is the UUP. It's the U.S. dollar. This is not. This is still in a lower descending channel, and we could get a little bit higher here. We're right at the pivot point, and we could get up here to around 26 and change on UUP. That's at the top of the thing. Once it gets up to that top of that channel and rolls over, we usually it comes back down. So I don't expect to see the dollar keep going, and especially with rates, especially with the yield down here at 215. Now, if the yield was back up here around 250, then we'd probably get the breakout of this thing. But here's the 50-day coming below the 200, so you kind of have a death cross on the dollar. That's something that you want to be concerned with. Here's this 14-day RSI. Remember, it needs to get above 60 if you're starting to get in a bullish trend. These bounces up, you still don't get to 60. You're getting up here to maybe 50. So that's telling you you're still in a bearish in a bearish trend. So that's not, you don't want to be going long the dollar in here. In fact, you probably want to look to short it. But as long as this thing stays on a downtrend, that's going to help. Especially the industrials and the multinationals. And down here, this accumulation distribution line, you can see that the dollar, this trade's not the dollar trade's not what it was back here. Everyone's getting out of that right now. So that's the chart you want to keep pulling up just to watch for a little bit. Now this next one, another reason, and this may be a chart that you want to keep looking at. This is the oil index. Last week we talked about, you want to get out of here. Everyone was talking about oil, and the OPEC was going to get together again, and we're going to have that big push surge in oil. And we talked about, okay, well, as far as what we see is we're at the top of a channel here, and this would be where you want to take profits. I got a couple of nice emails last week. Some people said that we'd saved a lot of money on that. I still think oil is going to have a battle down here around $40. We're at $43.05 today. Down another $1.15 a barrel, and we could go lower. My impression with oil, if we get down here and bounce around the 40 and you start to see that oil chip away where you start getting maybe even down into the 30s, that probably would end this a little bit of the bull market, and that would signal that we're probably going to have a rough summer. And again, this period right here is this is peak season, driving season, and all for oil and gasoline. This is not what you want to see during that. This is what you want to see over here during peak season for oil. If you think oil is going higher, not this. And again, you can see some negative divergence. The 14-day can't get above 50, 55, and even the 30 days stochastic, it can't get above 50 either. So that's a troubling chart to me. Now, this is something, if you've been with us the last couple of years, over here we talked about this a lot. This is the oil index going back, going back to 2008. So this is an 8-year chart of oil, and we talked about this. And we were going up, and came down here, and we broke below this, came up, tested that trend line upside, and rolled over. And we talked a lot about this at the time, that when you have a long-term chart like this, and you can do this with any sector or any kind of stock, whatever you want to, something fundamentally changed in oil at this stage, right in here. You don't have to know what it is. All you have to know is that this broke. It can't get back above that trend line, and something changed. You'll usually find out later on whether it was the emergence of electric cars, or whether it's the alternative energies like sun power, that kind of thing, solar energy, wind power, whatever was going on. that was the fundamental change where things shifted to the other side. And in fact, I even see today where ExxonMobil is investing money into and Total and a couple other ones. They're investing money in solar energy because they think that's going to be their growth period in a few years. So they're shifting their focus also. And this chart again shows you that oil is not going to be the place where you want to be. Now here's the energy select spider. This is XLE, and I told you this was going to be a little bit shorter today. So if you have some questions out there, go ahead and start putting them in. We're just going to look at one or two charts here, and then we're going to open it up to that. But XLE, again, you come up here to this downward descending channel. You got up here, and we told you to get out. Here we are. We're breaking down, gap down today. XLE is probably going to go down here and probably test, make a new low for the year. Here's your 14-day RSI. Can't get above 50. This thing would need to get a push above 65, 70 before you can think that the trend is changing in that. Here's the 30-day stochastic. Can't get above 50 over here. And here you're kind of seeing traders finally throwing in the towel. When it got over here with this bounce, maybe they thought, okay, maybe this is it, but we rolled back over. So again, oil stocks are not where you want to be, and if you're thinking long term, you'll probably get a chance to buy them. We thought we'd get a bounce over in here. We did, but that rolled over, and that was the end of that. Okay, last one I want to look at is what we talked about last week. Darn it, I'm missing a chart on here. I'll go over this in 1 second. But last week we talked about the breakout in the XLF. We saw this triangle, descending triangle. We got the break above that. We went to the industry group analysis last week, gave you a bunch of banking stocks, insurance stocks, asset manager stocks for you to look at, and they have done great over the last week and a half. So this is, again, just shows you the breakout in financials. Despite the 10-year staying down here, 2.15, I think you still want to be nibbling away at the financials. You don't have to go all in and chase this thing, because you may, if the market rolls over a little bit, you probably get a chance to come back down at this range around the 100-day and add to your positions. But one last chart that I thought I had on here, and I guess I erased it during my presentation here, and that is that we've been pounding the table a little bit about nibbling away at some of these biotechs, that if we got above about 298, and that 300 level would be the big breakout. But today last I checked, we were at 308, 310, and that's on the IBB Nasdaq. So you have a solid breakout. And in fact, that index is up that ETF is up about 2% today. So the horse is off on that one. Hopefully you were buying over here over the last couple of weeks. If you haven't, it's a hell of a move today, but you want to be exposed to the biotechs in here. Okay, I'm going to go ahead and we got a couple questions starting to come in. I'll share my screen here in a little bit so we can look at some of the charts. And go ahead and pop them in here now. SCO, ProShares short 3 times oil. I would probably, with today's move, the last 2 days move or so on oil, I'll take a look at this in just a second. But you might, the oil bulls, you always have a lot of bullish oil guys because they think oil's the only way to go. So you may get a bounce back to maybe 45 on oil. You may want to consider going into the SCO at that time. But let me look at the chart, and I'm going to go ahead and close this part of this off so we can share the screen with the charting package. So hold on right there. Okay, let's look at this SCO real quick. Okay, see that big gap up? You don't want to get that. You don't want to buy that here. But if it comes back down to this area here, this 45, 46 area, that could buy it. Even this over here, you know, you can see they're buying this, which means you know the people are getting short oil. This thing's overbought. You're at 96 on the 30-day stochastic. As long as it's above 8, that's trending, and you're back up here. You know, you remember we said if you don't go below 40, the trend's up. Now, you had a little bit of a crack there, but it turned around real quick, and now you're up here pushing 70. Like I said, I think oil has a chance to go back down into the 30s. So I would not be afraid to you know, to get in something like this. But it's just, this is too much, right? You know, from 40 to 50 right there. That's too much of a move too quick. Okay, let me take a look here on any more questions coming in. Nothing. Okay. Well, again, it's kind of a short one today. I was hoping we could get more questions on that. Like I said, the last couple of weeks, if you haven't joined us, you can go into the markets page, and if you go on to the actually, I'm going to pull this up over here. If you want to see some of the previous ones, if you go into the markets page and click on this on the Tech Talk. If you go down here to YouTube and click on that, you're going to get all the different Tech Talks over the last week or two, and you can go back and see what we were talking about a week or two ago. And I think that if you do that for the last 2 or 3 weeks, you'll find some pretty good stock selections that we've had. Okay, nothing else coming in. I guess make sure you read this week's Friday weekly market letter, because again, there's some things going on in the market that we want to make sure that if we're going to roll over and go to a bearish stance, then we'll probably want to grab hold of some of these triple leverage ETFs to the downside, to the short side. I appreciate you taking some time out of your busy day to join me today, and I hope you got something out of this. And we'll see you next week. Thank you.